All right, I'm going to go ahead and get us started here. Whoa, that thing's a little, well. My name is Todd Grantham. I am on the NAFA National Member Benefits Committee, and I'd like to welcome you to MDRT's Big Ideas presentation, Selling Large Life Insurance Policies to High Net Worth. Is it just adding a few zeros? I'm adding more than 1 zero, by the way. At this time, I'd like if everybody can do a few things. First, make sure we silence cell phones, whatever devices. If you want to tweet, as we learned about at the YAT presentation, that's great, but just make sure it's on silent. The other thing I'm going to do, as I'm introducing Dale, is if he'd like to have it intimate, so for those of you in the back, and back means not the first two rows, if you can just start moving forward, consolidate down, stand up, move, walk, that would be great. Otherwise, he's going to call people out by name, and, that's never fun. So as you're moving forward and bringing us together, Dale has 32 years experience in the financial services industry. He has extensive experience providing sophisticated strategies for high net worth families, executives, and business owners, and their professional advisors. He's a qualifying member of MDRT, spoken at many events throughout the country, and I think you're going to learn a lot while we're here today. So welcome, Dale. Thank you.
Right there. I look up and see Palm Beach Gardens now. I used to be Minnesota, so it's kind of nice, Palm Beach. Yeah, I talk like Minnesota, like Fargo, the show. You ever watch the full show? I appreciate you moving up because whenever I do these, I've done these at the MDRT meetings, and I like the intimate. I don't like the dialogue. I don't like the monologue. I like the dialogue. So questions throughout. It's not just me talking. I've got 34 years today of doing this stuff, and so I may know some stuff that you may not know, and I may need some information that you know. So really keep it as I'm going to plug my $1 Million Roundtable. I'd like this to be a roundtable, if we could, please. So it's very much a roundtable, okay? I said in the meeting today, I talked about I wanted to work with millionaires, and don't we all? And I said, okay, who controls the money? I did this about 20-some years ago. I asked the question, who controls the money? Well, show of hand. Who do you think controls money in this society? Women. Yeah, that's true. My wife controls our money. That's true. Yeah. Insurance companies. I'm thinking more of an individual advisors. What? You cheat. Well, bankers think they do, but they really don't. Attorneys really think they do, but they don't. CPAs, no offense to the CPAs in the room, they don't control the money. Wirehouses, brokers, they control the money. No matter, in my world, if you talk to the brokers, and in this case, some of you are in that category, but they control money. And I found that wirehouses and small brokerage firms, they think life insurance is a four-letter word. They just hate it. They think, just like my father's talked about life insurance people. I'm a broker. I'm not a life insurance agent, I always just laugh my way to the bank. I don't care what they call me, right? So I figured out that wirehouses were the ones that controlled the money. And so I finagled my way into a couple wirehouses and got relationships with some very high-powered stockbrokers that had very good control over their clients. And after a while, you get to be known as the expert in the insurance. I was the insurance guy, and I didn't care if they called me that. But what I told them to call me in front of the client was not estate planning guy, wealth transfer specialist. And why did I use those three words? If I say estate planning, what's the client thinking? Death, what else? Taxes, that's a good one, yeah. They're thinking attorney's fees. They're thinking technical stuff, trusts and wills and all this stuff, and they freak out. I don't want to talk about that. But when we talk about wealth transfer, it's a little softer approach, and I always tell the client, listen, we've done a good job, or your advisor and I have done a good job of growing your assets for your retirement. Now let's make sure that anything left over goes to where you want it to go at the most tax efficient way. It has nothing to do with estate taxes. It has nothing to do with life insurance. It's all about wealth transfer. And I'll get into some examples on that. So that being said, I decided to start doing that, and it worked. I became an expert in the wealth transfer area, and over time, you had about, just like you have centers of influence, my center of influence would bring me in, and I'd split commissions with them. And on average, we'd do $2 to $4 million of target premium a year. And I split that. That's not a bad, I can make a living doing that, So that's where I got into the million. I'm not suggesting there's ways that you can get in there. It's tough to get in. Down in Palm Beach, I got in with UBS, which is another big wirehouse firm. And I'm slowly getting the relationships there. I'm in competition with other general agents or whatever, so I'm working that way. But so far, I've got some nice opportunities that we're going to get. So that's how I got to that question. But I had a bunch of aha moments over the years. And the first one was that, I'll tell you the end. I had a client, 75-year-old, net worth of $150 million. Now, that's a good time, right? That's good to be in front of this guy. Right? And he had a $10 million annual growth on his portfolio. So in other words, his broker got him 6.7% on his portfolio. Okay? So we did some private financing insurance. Does everybody know what private financing is? Just in a nutshell, it's a great way if you've got somebody that's already gifted his $5 million exemption and he's already giving money to his kids. So he doesn't have ways of gifting money into a trust. He's kind of, right now, the applicable federal loan rates are so low. It's a perfect storm for the super wealthy. It is so perfect, it's unbelievable. But basically, you loan $2.2 million to a trust. And at this time we did 1-year notes and we rolled them, but it doesn't matter. It was like a 1 or 2% note. And therefore, the notes just accrued, so therefore, no gift tax. And the $2.2 million bought a $90 million policy on these people. Now, my South Dakota math, that's good. That's a good sale. That was a good year, that year. But my aha moment was 2.2% of the growth to increase net worth. So my aha moment is they think in terms of percentages, not dollar figures. So make sure you understand. We're talking to an ultra net worth person, high net worth, they think it's in percentage. Here's the true story. I'm going to go back, I think. We were at the final closing. I had 4 companies that stepped up and we're going to write. We had 4 companies. We had all the stuff ready to go, and the attorneys there, and the broker, and myself, and the clients. And I'm ready to go celebrate and have a good glass of wine. And the attorney says this. Is there any attorneys in the room? How many admit it? The attorney who I'd been working with on this, so it wasn't a surprise to him. He looked at the client and he said, Mr. So-and-so, I just want you to know, you don't have to do this. And I could have just died. It's like, at this point, what are you talking about? And he goes, you've got enough assets. He was liquid. The guy had lots of money to pay the estate tax. He didn't need this, but he was going to pay dollar for dollar. And we've already gone through that. And here's what the client said this. He looked at the broker and he says, you're telling me that we're going to take 2.2% of my growth and increase my net worth by 60%? And I'm going, yeah. And he goes, well, that's a no-brainer. So I'm going, yeah, that's a good deal, right? But that was an aha moment, that they think in percentages, not dollar figures. He wasn't saying $2.2 million. He was saying 2.2% of my growth, of my net worth. Not even my net worth, but the growth off my income. So keep that in mind. That was an aha moment number 1. Aha moment number 2 is appeal to their legacy. I picked this up from at a top of the table meeting, probably 14 years ago. At a 74-year-old couple, $8 million net worth, 3 children and 3 grandchildren. Okay, this is a pretty typical client that we talk with, right? And I said to the clients, I said, do you know the name of your great-grandparents? And of course they said no. If they do, you say, do you know the name of your great-great-grandparents? You need to get the answer no, okay? And I said, do you think you'd know the name of your great-grandparents if they're giving you $10K a year? And you always get a chuckle. And they say, well, yeah. And then the power phrase is, how would you like to be that great-grandparent? How would you like to leave a legacy, Mr. and Mrs. Jones, that every birthday of every linear descendant of you for the rest of eternity, on their birthday, they get a gift from great-grandpa and grandma Jones? How would you like that? And I'm telling you, they all love it. It's that legacy. And then I say, the Rockefellers do it, the Kennedys do it, maybe they add a few zeros to it, but that's what they do. And then you start appealing to things like, it's creditor protected, if done correctly. It protects from divorces, which is huge. It's only blood linear descendants. And you can set the trust up however you want. I've had one where the guy says, I don't want to create, hope I don't make any, a Paris Hilton's. He said, I don't want to create Paris Hilton's. So he had what they said was incentive trust. They set it up where the trustee, the child or grandchild, brings their W-2, and they'll match it up to a certain amount. So the only way they get money is if they got a W-2, so here's what I made this year. So there's all kinds of things that you can do. But the key to this idea is you gifted $1 million to a defective grantor trust, okay, to start, this kind of seed the trust. And then we put the trust, we had dynastic provisions. You put it in, we got some South Dakota residents here, you put it in the great state of South Dakota, and it goes on forever and ever. There's certain states, Alaska, South Dakota, Delaware, they're all over, that have the rules against perpetuity where you can have the trust go forever and ever. And they also started gifting $50,000 annually to this to purchase a $2.1 million. And then he says, well, why do I want to gift the $2.1 million or have the life insurance in there? I always say, well, we're going to supercharge this trust at your death. Because $1 million, that's not going to last forever. Your current grandkids are going to eat that up. But when you die, we need to supercharge it. We need to get more money in it for future generations. So I use words like supercharge or make it sound real. Okay? Next thing before I go, I always sit down and I talk to my centers of influence, because a lot of times you're talking to your CPAs or your centers of influence, your attorneys, whatever. They don't know what kind of person that you're looking for to work with, right? They think estate planning. How many times have you had people tell you, oh, they're not worth $10 million, so they don't need a plan? You get that all the time, right? And I don't want my centers of influence to even think about $10 million. That's not even, estate planning, estate taxes are secondary. I don't care. So I always say I'm looking for clients with four things. Can't read this slide back there. First one, they must have leave-on money. What does that mean? It's obvious. At the end of their lives, there's going to be something left over. It could be an annuity. It could be, it doesn't matter what the asset is, but at the end of your life, you've come to the conclusion that there's going to be something left over. Okay? Number two, they're healthy. Now, I always caution center of influence on the word healthy, because how many in the room has had people tell you, well, 70 years old, they can't get insurance anymore? All the time. I know, all the time. And if that was the case, I wouldn't be here, because every one of my clients are in their 70s, 60s, and 70s. So you got to debunk that. And so what you tell them is, think about healthy in relative terms. I'm 56, and I've got health issues. I've got a bad heart. So I probably can't get insurance. But if I was 80 or 78 with the same issue, I probably could get insurance. Because what I have is a bad valve, but if you live long enough, the insurance companies look at you differently. They figure, well, you made it that long. He's going to keep going. So people don't realize that. People that aren't in our business don't understand the health parts of our business, okay? Number 3, they love someone. A wise man from Prudential, 33 years ago, his name was Irv Nelson. He sat me down, he says, remember one thing, you will never sell life insurance to someone unless they love someone. And that is so true. It is so true. You get people that say, I don't give a crap what happens to me when I die. You're not going to sell them insurance. Maybe not for the death benefit. You may sell it for the investment side of it, but they have to love someone. Okay? And 4th, they trust, in my case, the broker, or trust the advisor. Because if I have to wow the client with my super intelligence, we're in trouble. This is a relationship business, right? So if the client already relates to the center of influence, the attorney, the CPA, whatever it is, and you're just coming in as the expert, they have to really trust to this. Now, if you're that advisor, then this is a no-brainer. Okay? And I'll give you an example of why you look at it this way. We had a 75-year-old male that was a widower, and he lived on a railroad pension. If any of you had any railroad pensions, those things are great. I mean, those guys that have railroad pensions and live forever, and they'll never run out of money. And he was worth about $1.4 million, $1.5 million, something like that. And I did a presentation in Wisconsin, and one of the advisors came up to me and he said, hey, I got a guy, he's only worth about $1.5 million, but he may have some money left over. I would have never got in front of that guy if I would have talked about estate planning, right? 1.5? Never get in front of him. But because I did this, the broker says, I got a guy, he might want to talk to us. So we went and talked to the guy. He has 1 child and 1 grandchild, and he's worth 1.5. And I talked about the charities. He didn't have any charities that he really liked. I talked about the different types of trusts that we can move money around. But then I said, what are you going to do with this? He had a $400,000 annuity that he bought 15, 20 years ago. And I said, what are you going to do with that annuity? He goes, I don't know. I bought it way back when, and I put $100,000 in, now it's worth 400, and I'll probably just give it to my daughter when I die. I thought, well, we could take that annuity, annuitize it, right? Get $35,000 income off of it, and buy an $800,000 life insurance policy. So what did we do? We took a $400,000 taxable asset and turned it into an $800,000 tax-free asset. And by the way, the commissions weren't too bad on that. So the bottom line is, if you approach people, clients, whatever, with these 4 criteria, you get them off the dime of estate tax, estate planning. I mean, I keep things so simple, it's almost embarrassing. I was telling this young man this morning that it's embarrassing. I get in competition with the attorney or the other guy, and he's got all these spreadsheets, and I come in with I have literally a white paper and just start drawing. And I get the case most of the time. It's just amazing because the clients, when they throw all that numbers out, their eyes roll over and I don't know what that is. I just talk to them with a white pad. I was joking with you. I'm not even a social media guy. I just got on Facebook last week, only because my daughter made me, because now we live so far apart. She says, I want to be able to send you pictures and stuff. So, and I hate it, by the way. I can't figure out when to like or when to unlike. I don't know what that means. So she gave me a hard time because I liked my own picture. I didn't know. She goes, no, you don't like your own picture. I said, okay. So anyway, I'm just an old-fashioned guy. Another thing that I use before I get on to some more case studies is a timeline. I sit down with clients. And I say, Mr. and Mrs. Client, this is your life. This is your timeline. From age 25 to 65. Why do you think people buy life insurance? Then they shut up and listen. So I'll shut up and listen. Why do you think people buy life insurance? Protect your family. What? Send the kids to school, okay. There's one word that is so important that we're missing. If. People buy from this age if they die. What's the product that's most often sold? Term insurance. And I'm a big term person. It's a great product. It protects a specific time frame. There's nothing wrong with term insurance. By the way, the best thing about term insurance, it's convertible. That's the best thing I know. And I laugh about this. I literally just found out a month ago that I had this heart defect. Just found out. I did an insurance exam. Lincoln, thank God, gave me $2 more million worth of coverage, right? But they said, there's something on your EKG. We don't know how much it is, but they gave me preferred. Okay. So I pay for it, and I said, I better go get this checked out. So I go and get it checked out. Sure enough, I was born with what they call a bicuspid bilateral arterial valve. Most people have three flaps in their valve. I only have 2. And eventually, it goes out. And my arteries, my aorta is getting larger. It's supposed to be at 3.8. Mine's at 4.3. When it gets to 5, it's see you later. So they watch it, and I'm going to have a heart valve replacement. Kind of scary. But needless to say, I'm done buying life insurance. I mean, I'm not going to get it anymore. But guess what I'm going to do with that $2 million policy in 20 years or 19 years? I'm going to convert that baby. So term insurance is great for clients for this area. Okay. When you get to this stage, Mr. and Mrs. Prospect or client, what word changes? When. And it's amazing they all know that. And then I say, now, can we use this product over here? You can, but it's not very productive because I don't know if the statistic is true, but I've said it all the time, so I hope somebody can help me with. But I heard, if it's not true, I'm sorry, but I've heard that like 98% of term policies don't pay out. Has anybody heard that? Yeah, okay, so it's not. Because they either lapse it or they outlive it. So if you knew exactly when you're going to die, great, you'd buy term insurance, but we don't. So we have to buy some type of permanent insurance. So I say this. When we get to the point where we're talking about insurance, I start talking about life insurance in this format. I don't get into the variable life and the indexed UL and all that stuff. It's just permanent. You need it for this particular case, okay? So I go ahead and use that. I use it a lot. It works, and it's funny. It's a good interactive piece with your clients. They kind of like it, and I always make a joke. They always know the win. Everybody know, when I say that, everybody knows win. Okay? So they buy a legacy. Okay, aha moment number 3. I was talking to somebody earlier about 2008 changed their minds about life insurance as an investment. Why? Yeah, the market crashed. Everybody thought investment or real estate, I can get 10% on real estate. Why do I buy life insurance, right? Every one of my high net worth clients that didn't buy the old whole life stuff that I told them they should buy, or the index or whatever it may be, they all came. And is there any Northwestern Mutual people in there, or New York Life people? God love you. God love you. Because you guys are just great ambassadors for what we do, and you're great at getting out there and telling the whole life story. I'm telling you what, I have sold more whole life this year than from 10 years prior. And it's all because of 2008. And I don't have Northwestern, but I use MetLife or Mass Mutual. There's some good mutual whole life companies, but Northwestern Mutual, New York Life, they're all good. But I'll tell you what, changed their mind. They came out of the woodwork wanting to talk about what's this. There's a guy down in Florida, I forget what his name is, but he calls them 770 accounts. Ever heard of those? Basically 770, it's a great marketing strategy, but it's nothing more than the code, IRS code that talks about the inside tax-free buildup in life insurance. But these are 770 accounts, It's genius. I thought it was great. I wish I would have thought about it. But he's down there marketing it for me, so I appreciate him very much. But I had a male age 40. He had a $750,000 annual income. So good guy, right? We want to talk to these people. Married, 2 children. Same guy in 2008, he was making about $500,000. I told him about what I call life insurance retirement plan, or in other words I use is insured private pensions. Call them whatever you want, but I talked about whole life insurance. I like whole life. I'm sorry, I'm not an index. I know that there's some great things about index, and I should learn about them. I get freaked out a little bit about them. Plus, think about it. My clients are also clients of brokers, and brokers tend to know a lot about market-linked investments and index. They kind of get that stuff, so I don't want to infringe in their world. So I'm just a whole life junkie. I love it. So I sell a lot of that. But this guy, we decided we put $50,000 a year for 10 years for a total contribution of $500,000. Annual income distribution at age 66, tax-free. Current crediting rate at MetLife is 5.05, so that's what I ran it at. How many think that's going to go up? Eventually it's going to go up, right? But they're going to take $1.9 million out over that time, tax-free. So at age 85, the cash value left after it's all said and done is going to have $273,000. The death benefit is still at $791. Total benefit to client heirs, $2.7 million tax-free, and he put a $500,000 investment into it. The internal rate of return is pretty good. So my aha moment number 3 is high net worth clients love saving taxes more than they hate life insurance. And so it's so true. You know, they hate the word life insurance. Life insurance is a bad investment until you roll. And by the way, I never showed an illustration. We talked about that. I don't show illustrations. I show those numbers. I have the illustration because legally I have to, but I don't roll out that illustration. I just write it all down and say this is what it looks like. So what I like about selling whole life in this respect is say, okay, if you did this in a pension plan, and let's say that it was just like any other investment, and you died 10 years into it, what's your widow going to get? What you put in plus some investments, right? Well, with life insurance, I think the death benefit on this started out at it's going to be around, a little over $2 million. So it's a planned completion. It's there when you live, but by the way, when you die, your wife's going to get it. You're not going to penalize your wife because you did this outside of life insurance. The other thing about high net worth clients, misery loves company. They all like to know what the other wealthy guy down the street's doing. So name drop is great. Learn about what the Rockefellers did, the Kennedys did, because it's all public knowledge. You can get in and find out that. And you say, hey, this is what Kennedy did, or this is what if you look at the CEOs of high net worth company or Fortune 500 companies, they all have huge whole life policies. They all own them. It's amazing. So anyway, my aha moment was that. Aha moment number 4. I talked a little bit about this, but don't lead with life insurance. When I talk about wealth transfer, I don't come in and talk about life insurance. You have to become an expert in a lot of things when you're talking in this area. You can't go in and not know about charitable planning, charitable lead trust, charitable remainder trust, all the stuff that you just have to know it. And this is not going to be the time for you to learn it, but you got to know all the different concepts and what a defective grantor trust is, what private financing is. You got to know that stuff if you're in this marketplace. So here's the thing. This is a true story. I was in Des Moines, Iowa. We got any Iowa people here? I saw somebody. No, I was in Des Moines, Iowa. Love that city. And a guy walked in the door. He was Indian, not American Indian, from the country, India. And he owned hotels. He owned like 50 hotels. He's worth about $15 million. And he brings in we're going to have a discussion about transferring wealth. He brings in his son, his new daughter or daughter-in-law who was pregnant, and his wife. Never met the guy before. He walks in the door and he says, Dale, I just want to tell you, I do not believe in life insurance. So I said, that's fine. That's cool, I've learned never. Okay, so I go through what I do, and just so you know, a strategy that I do a lot. I always say, and before the meeting, I know this is everything in your estate. So I'll list all the dollars, their homes. In his case, he had some real estate. I list the dollar figures that's in his estate. And then I say I got this IRS wall that's impenetrable. I always screw that word up. So impenetrable. You can't get through it. The IRS doesn't let you drill through. There's only 2 ways or 3 ways you can get through this wall. You can give 15 or 14K a year to anybody you want, or right now, you can gift $5.3 million to anybody you want, tax-free, gift tax. And what are those? Those are the annual gift exclusions and the current unified credit, okay? Or you can get everything to charity. Well, he didn't want anything to do with charity. No. Everything he wanted to do was given to his kids and his newly grandchild that was coming. So I talked about gifting strategies. And we talked about charitable trust. We didn't like that. We talked about GRATs and how to take some of his assets, his real estate, and peel off the growth with using grant to retain annuity trust. Again, that's a whole other discussion. I don't want to get into that. But I talked about all that stuff. And then I said this. I said, you could take $1 million. I think I got that. Get ahead. You can take $1 million, stick it in a trust over here, and immediately make it $5 million. Just like that. And he perked up. He goes, looked at his wife. He said, that's a pretty good deal. I said, the problem with that, Mr. Khatib, is you can't have it. And he says, what do you mean you can't have it? I says, because you don't believe in it. You know what he said to me? He goes, you're good. Yeah. And so the moral of the story was, I put it on there, don't panic. If he, again, 30 years ago, if he would have walked in and said, I don't believe in life insurance, what would I have done? I would have started saying, what do you mean you don't believe it? It's nothing more than, I would have started arguing with him, and I would have never got the sale. I got this sale. This is a good one. He put $1 million single premium into a universal life policy and made it $5 million, and he's happy. We put dynastic things in it so his grandchildren are going to love me. He loves me. So that was my aha moment there, is don't panic when they throw things at you. Just say, oh, okay, thank you for sharing or whatever, and then pick your battles and figure out when to do it. Aha moment number 5, change your attitude when you're talking to high net worth clients. I used to think, geez, the guy's going to give me $100 a month. I couldn't afford $100 a month. How is he going to afford $100 a month? You know? So you start thinking too much about what the client's thinking. Act like you've been there before. I love that when, I don't forget what football player it was, but I think it was Walter Payton. I think Walter Payton said it. You know, he never saw Walter Payton spike the football or do anything. He always said, well, I'm going to act like I've been there before, and I'm going to be there again. So why should I celebrate? That's my job, you know. So I would just say, I always say this, fake it till you make it kind of thing. You know, just say, yeah, no problem. Don't allow anyone to intimidate you. Here's a line that I've used so many times. If you get in a situation, it's one that you can pull out of the back pocket just last second. But let's say you have a client and an attorney, and your attorney is just bucking you and just kind of fighting you the whole way, and he's just kind of being a pain in the butt. And you've had everything you can do. You can't make him come around, and you look at him, and you say, Stephen, have I done something to offend you? And I am telling you, the defensive, no, he'll usually make something up. I had a bad day today, or, you know. One time I did that when the client was being, or the CPA, or it was the attorney doing it being that way. After when I said, have you done something to offend you? The client said, yeah, Steve, you're kind of being tough on him. What's going on? You know, so it was great. You know, so I'm just saying, sometimes attorneys, they're not bad people. They're great people. I need them. I can't do the stuff that they do. I'm not an attorney. So sometimes they just have had a bad day, and their role is to make sure that they're protecting the client. So I always give them a break. But sometimes, and I've done this a lot of times, I make it their idea. So if we're going to go see the client, I call up the broker or the attorney, and I'll say, listen, here's the things I was thinking. What do you think? And if he says, yeah, that's a good idea, I said, well, why don't you present it? Why don't you, you know? And they love that. So, you know, let them have the glory. You just cash the commission check, right? That's the hard part about attorneys. They hate the fact they know how much we make. That guy that tried to nix my $2.1 million deal, you could tell the dollars, he gets 50% of that? Son of a, you know. You could tell he's going, hold on, that guy's getting paid $1 million. How you get paid, $2,000 for drawing up the trust, So, stay calm. Silence is a good thing. That's another thing I've learned over the years. It's okay just to be quiet and let the client think about things. I always go into a meeting with about 2 questions that I have memorized, that if I need to kind of break the silence, I'll do that. A technique that I picked up at MDRT, I keep plugging it, but the technique I picked up was, if you're going to have a discussion about wealth transfer, and you really I don't want the client to come in talking about numbers and stuff. I want them to talk about what's in their heart. So what I start out by saying, if you two were a couple, I'd say, I always ask the female first, because if you ask the male chokes. Trust me, the male will choke on this every time. But I'll ask Judy, I said, Judy, and let's say you've been married for 40 years and you got kids. I said, Judy, what makes Matt a good husband and a good father and a good provider? What makes him good? And of course, she's going to start talking about glowing how great he is. And he's a great father, and he's been sometimes tears come. It's kind of a nice thing. And then I turn the story to Matt, and I say, Matt, what makes Judy a good mother, grandmother? And then because he's thinking, he knows he's coming up. Because if you do it, the man, I'm telling you, men will choke every time. But the women, when they know, they'll do it right away. And then, of course, while she's saying, he's thinking, oh, shoot, he's going to ask me. So I better have an answer. So, but anyway, and then we get done talking. And I said, there's a reason why I did that. I want you to come in and talk to me about what's in your heart, not what's in your head. I don't want you to talk to me about trust and insurance and all the stuff that you think we're going to talk about. I want to know what's here, Judy and Matt. I want to know what you're thinking, where you want your money to go to, what's important to you. Do you have certain goals in mind when you're gone? You're up in heaven, you're looking down, and I don't want you to be disappointed. So tell me what you want. And that little strategy really gets them to think about the feelings and the reason why we're here. If you go in, and I've had a lot of times, here's another technique I pick up. When we're done with the meeting, don't say goodbye to them at the elevator. Walk them down to their car. We picked that up at MDRT, I think somebody said that. I started doing that. It's so cool. They start talking to you about, I've been to a lot of meetings. That was the best one I've ever had on estate planning. I really get it now. Thank you so much. Because it was a good meeting. It wasn't about dollars and trusts and taxes. It was about what they want with their money. So there's a technique I use. So I always have questions that I have at the tip of my finger that I can throw out at the last second. So number 5 is just add a few zeros. Again, I used to think anybody that was going to give me $10,000 a year, I'd say, oh my God, $10,000 a year. I mean, I'm not sitting up here bragging. I don't like to do that. But, $10,000, sometimes I don't even want to do those anymore. They're not big enough. That's my ego. That's my ego going. But it's just, your mentality for the high net worth is just add zeros. It's that simple. Somebody says, how can a guy, like we went to dinner last night with Greg, and there was a yacht in the harbor, right? And I said, what do you think it cost annually just to slip that yacht? What do you think? I'm asking. 75 to 100. I guessed about $100,000. And I said, can you imagine spending $100,000 just to slip it, just to let it sit there a year? And then we were talking. I said, but $100,000 to them is like $10 to you and I, because they're worth, $400, $500, $600 million, $1 billion usually. It's all relative. And that's the mentality that was hard for me to get there, trust me. I grew up on a farm in South Dakota. I'm telling you, I didn't have nothing. I mean, I could tell you stories about stuff I had nothing. So for me to sit up here and talk about $1 million like it's nothing, it's a big deal. But you have to change your attitude when you're talking to the high net worth client. It's just different. But it's the same. They're the same people. They're great people. They just think differently. Any questions, concerns, anything that you want to fire away? Yeah. You got to understand, most of my clients are in their 60s and 70s, so no. But I do add that long-term care rider that somebody talked about. I think Van was talking about it. I tell you what, that's a great product. If you're not putting it in a trust, for example, that 40-year-old, I did waiver premium on that 40-year-old for the $50,000. You put the long-term care rider on that stuff, and that is a great way. Another idea is you've got a lot of these My Northwestern Mutual friends aren't going to like this, but a lot of times they buy all these whole life policies, and now they're in their 70s, and they really don't need the death benefit that much, but they want long-term care. You can 1035 those into a John Hancock or some other nationwide product and add the long-term care. Can John Hancock or can Northwestern Mutual add the long-term care to existing contract? No. Are they looking at doing it? Please say no. Be- but you could 1035 them and do the same thing. Yeah. We'll talk. Yeah. Oh, yeah, but then you won't get paid. I don't sell MetLife in that area. I use the John Hancock with their long-term care nationwide or whatever. But that's a great story, and that's not just Northwestern Mutual. I'm just picking on them. But any contract that has some cash value in it and it doesn't have the long-term care rider on it, you can pick up nice little sales with your clients. I'm sure you guys are already doing that. It's talk, but yeah.
You only use whole life, so do you use single premium limited or whole life?
Yeah, when I get to the larger ones, the estate planning ones, I don't use whole life because you can get a lot better death benefit with a UL, a guaranteed UL, or a index UL with a guarantee. Lincoln, I'm a big Lincoln fan. Lincoln has that variable one with a guaranteed death benefit. So it's priced pretty reasonable. I mean, you can get a lot more death benefit guaranteed than you can in whole life in that case. Whole life is a great product to grow cash value. I love it for that. But for estate planning purposes, maybe my Northwestern Mutual guys will argue with me. I just think for estate planning, when it's death benefit only, it's tough to. You have to live. You have to live till age 86 to break even sometimes with the guaranteed stuff.
So you're just minimum funding?
Oh yeah,
Or max funding?
minimum funding. You don't want cash in it. You want to design it so there's the perfect thing is to die with zero cash value in the thing. That means you the performance UL or protection UL from John Hancock. You can really work with the cash value to make sure that at age 105 it's zero at current. But you got the risk of the crediting rates. So if they want guarantees, there's product for that. But I like the John Hancock one. I sell a lot of that.
So are you selling an individual policy or are you selling like the survivorship?
It's better if they're both live. Survivorship is better if they're both alive or if they're both healthy. But yeah.
Now the illustration you showed where the person will start taking money out at age 66 to age 85.
Yeah, that was the whole life.
Yeah, you were saying that it was tax-free, but if they had a gain in there,
Take loans against it. Withdraw the bases and then take loans. Actually, it's sometimes better just to take loans from the start. Yeah. Now, I know the compliance person in the room is shuddering because you can't say tax-free. You have to say tax-favored. Screw them. It's tax-free. It's tax-free. I don't care what, it's tax-free. Right now, the code says you don't pay tax on it. In Colorado, is it? So.
Target marketing. Who makes $150 million in South Dakota?
This is in Minnesota. This is in Minnesota, Minneapolis. He was an entrepreneur. He owned and operated a bunch of businesses, sold his business out about 5-10 years ago. There's a lot of wealth. Unfortunately, he just passed away. I wrote the guy that invented the Frosty from Wendy's. Think about it. The beauty of our jobs is we get to meet people and how they make their money is just amazing. And you're kind of going, I'm sitting here trying to sell life insurance, and you made a damn ice cream machine, and it's crazy, but it's cool. But yeah, it's there. I wrote a lot of this whole life idea. If you have any professional athletes, they love it. They love it.
I'm glad you mentioned that because I was curious about your approach. You talked a lot about how you develop the case in the meeting and the close, but for someone like me starting out in the business markets, how do you develop those relationships to get in front of those right people?
Yeah.
And I know it has a lot to do with synergy of influence and things like that, but can you just...
I'll give you a hint. Become an expert in something and then get the word out. I became, in Minneapolis, back when it was popular to do, now it's not so popular, but I was the expert in premium financing. I knew everything about premium financing. The Julian Malvasi, the guy out here in California, he was the one expert out here. I was the expert in Minneapolis, man. And I got so many referrals into wealthy clients with that, I sold one. It was a great concept, and the one I sold got upside down and I got my hand slapped and it was nasty. It's all interest rate arbitrage, is all it was. But I became an expert, so I would say become an expert in something and get the word out that you really know your stuff in this area. And eventually you'll get the people calling you. Yeah.
As far as your, I guess, the sales cycle for one case, how long do you hang on, or do you kind of have a time frame that you set for yourself?
No, the larger ones, I mean, that large one, it was a year.
Okay.
A year in the making. Met with the client a year, and it closed in December of 2005. So I really don't put a time frame on, because if you do that, again, it's different if they're your clients. You have a little bit better control. I'm the third party. I'm coming in. It's a little different for me. Now, I do have my own clients, and my own clients, China eggs, we've heard that you hang on to ones. Sometimes it's better just to get rid of them. But
The longest one for me has been 6 months.
6 months. You know, with the, I don't know about you, but the compliance these days, getting cases through compliance. I mean, yeah, if you do a replacement nowadays, I think you have to will your firstborn son to get those things through. It's crazy. Yeah.
I have a question. When you're targeting brokers to try to develop a relationship, obviously you're targeting those firms that don't have internal insurance.
Right. Some of them do.
Because Merrill Lynch did it one time.
Yeah. And I was the internal. So, didn't like that. Yeah. Because then they own you. But it's tough because you're in competition. But, you know, you got to have confidence in yourself. I just kept saying, listen, I'd tell the corner office broker, I'd say, give me one shot. Give me one shot in front of one of your best clients or a good client that fits these 4 criteria. Give me one shot. If I mess in my pants, then don't give me another shot. But if I know I won't, give me a shot. And I just, down in Jacksonville, Florida, I finally got this guy to give me an opportunity to meet with his client worth about $8 million. He had $5 million in an IRA. $5 million. Yeah. And we got done, I did my whole thing with the in and out, this thing, and we ended up talking about legacy planning. I did the old, do you know your grandparents thing, legacy planning, and that resonated with him. And he's going to end up putting $500,000 in and then gifting, I think, $46,000 a year to buy some life insurance. And before the meeting, I forgot, before the meeting, the broker goes, this guy will never buy life insurance. He'll never buy life insurance. I love those words. You know? It's like, yeah, I'll show you. So we get done, and sure enough, the guy says, I want you to call my attorney. I want him to drop the trust. I gave him the Inquirer. I do informals. I don't do formal apps. I do informals. And I gave him that to fill out. And we walking out, and I walk into the car, and they're happy. Come back, and the FA, the broker goes, I can't believe, I never thought they'd buy life insurance. I said, well, there's where you're wrong. They didn't buy life insurance. They bought legacy trust. And that was his aha moment. You know, these brokers or your centers of influence think of you as selling life insurance. You got to break that mold. You're not selling life insurance. You're doing planning. You're doing legacy. Life insurance is just a tool. It's just a product that helps solve a need. But do not go in there thinking you're selling life insurance. So I don't know if that answers your question, but what are you doing? Okay.
Do any of the brokers ever want you to use variable life because they
Oh, yeah.
like the rate of return
Oh, yeah.
potential?
Oh yeah, I show them all. I show all 3. I show a whole life, indexed, and variable life. And I have a little chart. You want conservative with limited upside potential. Talk in terms like they understand. Upside potential and downside risk protection. Or you want limited upside, that's whole life. If you want upside potential to a limit, but some downside risk protection with index UL, you can get the 12% ceiling with the 1% floor. You know, here's one. If you want unlimited upside potential, but no downside risk protection, that's variable life. And then I let the FA choose, you know, what do you want me to show? And he goes, well, show all 3. Or he'll say, well, I think this client's going to go this way. So I always, it's the old story, I'm a big story guy, but you walk into a restaurant and you see a guy eating something as you're walking in, a plate of something, and you go, oh, that looks really good, I want to get that. And you sit down at your table and the waiter comes and gives you the menu. And you're looking for what that you saw when you came in, it wasn't on the menu. And you get kind of angry, how come that's not a menu? And you ask him, well, he ordered something special off the menu. I say with life insurance. Put it on the menu. If you don't put it on the menu, somebody in this room is going to follow you and show them something that wasn't on the menu, and you're going to get embarrassed. So put it on the menu. Show them. Full disclosure. They have some great products. And the long-term care rider is I love what Van said. I tell you what, that's the next best thing that we've got in our quiver that nobody else has. It's a great product. Yep. If they're not licensed, I love it because then I get it all. But yeah, a lot of them, they like the commission check. I had a guy in Minneapolis, I won't say his name, but he does about $8 million a year in production. He's got more. Is anybody here from Minneapolis? You know Denny Hecker? Yeah. Well, this guy bought Denny Hecker's house. so I mean, this guy's got more money than God. And it was so great. I built that bond with him. He's the best social marketer in the world. And he would get a name of a famous person when the coach for the Gophers came in town. Within a week and a half, I was in front of him. He'd call me up and say, you need to go see Frank, or you need to go see here. I don't know much about him, but I know he's worth a lot of money. Go see him. So, and literally all he did, he joked about it, but he would sign the application and then get a check. He didn't do anything. He just referred me in. And some of his checks were six-figure checks. So, do you think he liked me? Yeah, he liked me. But, yeah, some of them don't. The ones that get it trust me and they say, you do it. I don't want anything to do with it. I trust you. The ones that want to have all the knowledge, they're a pain in the butt. I had one just the other day. I talked to him about an 81-year-old woman. We were talking about some dynasty trusts and stuff. And first she comes in, the first thing, I brought Dale in here. I've never worked with him before. He goes, I brought Dale in here. He's going to talk to you about some life insurance. I'm going, she just shut down, and we never got it. And I told him, I said, God, if you would have said he's going to help you talk about transferring your wealth, we'd be walking out with a nice check right now. But he blew it. You mention our product, unfortunately, love it or leave it, people don't like it. They don't, because it talks about death. They don't like it. I'm just saying don't lead with it. But yeah, brokers love the check, if they're licensed. If they're not licensed, I say that's too bad. Any other questions?
Two questions. One, how do you ask for referrals? What's your methodology?
Well, for one thing, I don't ask for referrals to the client. I'll ask referrals from the broker. So it goes back to who else do you know that fits these 4 criteria? Then it's not a name. But so I don't ask, my clients, the ones that I have personal business with, I'll ask for referrals. But a lot of times it's more of a social thing where I know that they know somebody, and I'll say, hey, can you introduce me to somebody? I learned this one time long ago. I said, if I wanted to meet Steve, and I knew you knew him, I'd say, if Steve walked in that door right now, would you introduce me to him? And of course you'd say, yeah. I said, well, that's all I'm asking you to do. Just introduce me to him. I'd like to get to know him. So that's kind of a nice way. But I don't have to do a lot of referral, unfortunately. Good news. Yeah. Oh, one other question, yeah.
Yeah, the second question is, how do you find new CIs? How do you...
It's funny, once you start getting those big checks, word gets out. This is a true story. The $2.2 million case, the guy that bought Denny Hecker's house was a corner office guy. He always did big business, but he didn't do anything with me. It was Christmas week, and after we closed that case, I had bought a bunch of wine, and I was bringing the wine to his secretaries because they helped so much with everything on that case. And I'm sitting there drinking or giving them the wine, and the guy from the corner office, he goes, Dale, come here. So I walk over to his office, we sit down, and he goes, tell me about that case. That's a big case. And I said, yeah, and I told him what it was and about the client. And he goes, well, I've got clients like that. I said, I know, I've been trying to get to you for 4 years and you haven't talked to me yet. That one case, he became a consistent producer with a referral for me every year. So the answer is, you get successful at something, the word gets out, and they start telling you. And then it switches firms. Brokerage firms, they talk to each other. You know, just because they're ones with Morgan Stanley or LPL or whatever, they kind of know who they all are. And they'll be out to a dinner or something. Hey, you know, I use that Dale Martin. He helped me close this big, and I'll get a call. Hey, so-and-so said you did it. It gets out. Money talks and bullshit, you know what. So, yeah.
Do you ever design some of your permanent life insurance cases as tax-free pensions?
You probably got to stay away from the word tax-free, but I call them insured private pensions. And the reason you stay away from the pension word sometimes is because they think it's qualified money. So you got to make sure you tell them, no, this is non-qualified. But another word I use all the time is super Roth IRAs. Everybody kind of knows what a Roth IRA is, but you know that there's limits, especially in the high net worth client. They can only put so much in, they can't put it all. Well, this is like a Roth IRA, but there's no limit. You can put whatever you want. And I would never say whole life insurance. You know, at the end, you're going to have to tell them what it is. I'm not saying it's a shell game, but it's just like that guy, that Indian fellow, that he had that mentality that he didn't believe in life insurance. Well, he didn't buy life insurance. He bought something to help him do a legacy for his family. We're just done. One more question. One more.
I remember one of you said together should have some leave on money. Are you looking at a designated amount of money, or are you just saying, well, they'll have something left?
No, you do. What's nice is what I'll do is before the meeting, I'll talk to the broker or the center of influence and say, have they done a retirement analysis? And usually they've done some type of retirement analysis where they show them the probability of them outliving their money. And if they don't have any leave on money, I don't want to talk to them. But if they've done this probability and if there's a 98% chance that they're going to have money left over, then they fit those 5 criteria. But that's usually the hardest one to overcome, is if they don't think. I've met clients worth $100 million think that they're going to run out of money. I mean, in mental. And if you don't get them, I always go back to those 4 criteria. If you don't get them to understand that they've got leave on money, you'll never get them to buy a life insurance. You're not going to do it. You've got to have them committed to those 4. Yeah.
On the $10,000 per grandchild, great-grandchild, how do you calculate how much life insurance?
That was just an example. But what I usually do is I figure out what needs to be done as far as a growth rate. So take a 5% growth rate on the asset. And then if they got 3 kids, whatever 5% will kick out. But then that's where you get the attorney involved. The attorney will design the trust because they'll put caps on it, say $10,000 per heir, or whatever is, or the growth, whichever is lower. So you got to protect yourself so you don't use all the money. But it could be 4,000 one year. But that's where when you get to the attorneys, they'll put together the formulas. That's a good question. I don't, for today, I just kind of gave you an example, but yeah, you really got to get a formula in there that make sure you don't run out of money. Yeah.
And then how many years are you paying the grandchild? That's what I'm asking.
For the rest of their life.
Okay, you're just giving interest on it.
Yeah. That's what this one did. You know, that's why you want to buy a lot of life insurance. Yeah. So, that's it. Hey, before we leave, I hope I remember this because I always like poems, and as you know, but this is a poem that I probably will butcher it because it's a hard one to remember. But a salesman stood at the pearly gates, his head was bent and low. He meekly asked the man of faith the way that he should go. What have you done, St. Peter asked, to gain admittance here? I've sold life insurance, sir, for many and many a year. St. Peter opened wide the gate and gently pressed the bell. Go right in and choose your harp, you've had your share of hell.